All right, welcome back, everybody, again to the Quick Carbon Podcast, episode 28 now. If you hear thunder in the background, I do apologize, but I have no control over that. If you want to support the podcast and the channel, or more rather, my ability to continue existing, then Patreon and PayPal links both are in the description below and in the pinned comment. But all else aside, getting started with our number one thing, the U.S. drilling rig count. Is it still decreasing? Of course it is. But it is no longer plummeting by enormous amounts. This time, over the course of this week, it actually only dropped down from 339 to 318 actively drilling rigs, as the price of oil is now back up over $30 per barrel, hanging around 33 or so. Granted, it's not high enough to spur anybody to start restarting any operations. The numbers for individual states are Texas dropping down to 138, Oklahoma remaining the same at 12, New Mexico dropping a bit further down to 63, Louisiana remaining the same at 35 rigs, North Dakota dropping a bit further down to 14, Pennsylvania dropping one further down to 22, Ohio remaining the same at 8, California holding on to 5 rigs, doing, some consistent enhanced recovery, trying to keep those midway sunset fields alive. Colorado drops a bit more down to 6, and West Virginia actually added 1. They went from 7 back up to 8 actively drilling rigs. So the overall descent has slowed. Is it still going to go below 300? Yeah, that's pretty guaranteed at this point. I feel like it'll probably go down towards, overall it'll probably end up going down towards 250-ish. But again, that'll all, of course, depend on oil price. Now, in terms of natural gas, we have the weekly numbers. U.S. natural gas production continues decreasing, now down from 103.3 down to 101.1 billion cubic feet per day, after hitting a potentially second and final peak of 109 several months back. U.S. natural gas consumption coming in for this week at 77.6 billion cubic feet per day, and the individual numbers within that being heating demand now down to only 12.5, consumption by natural gas-fired power plants 26.8, natural gas exports on LNG tankers 6.2, and consumption by the pipelines for its own pumping system fuel coming in at 6. U.S. natural gas storage inventories currently at 2.5 trillion cubic feet in storage. In comparison to normally at this time of year, they would still on average be down at 2.1. And last year, which had been a very high demand winter, they were still down at 1.72. And natural gas prices were, as of the last time I looked before recording this, around the $1.70 range. And the one other energy thing before we move into a bunch of metal data, U.S. electricity demand continues recovering as a lot of stuff is starting back up and a lot of places are reopening and trying to return to semi-normal. Normally, around this time of year, U.S. electricity demand over the course of the day would have a peak demand level somewhere between 5 p.m. and 8 p.m. of around 500 or 510 gigawatts or 1,000 megawatts of active electricity demand, and a trough or a low point to the demand in the middle of the night of usually around 390 or maybe 400 gigawatts. During the most shut down period of this whole time, the U.S. electricity demand was all the way down to having its peak only be around 430 and its trough in the middle of the night getting as low as 315. Now, as of this week, the numbers are averaging out to the trough still being pretty low in the middle of the night, around 330. However, the peak in the middle of the day as many more businesses are now back open, is back up to getting up towards 450. Now, moving onwards into metals, gold inventories still climbing as gold demand, particularly from jewelry, as unlike the others, jewelry still makes up actually the major portion of gold's demand. Gold demand, in that regard, in terms of jewelry, has not recovered at all to its pre-virus levels. So gold inventories are still swelling up, climbing from 24 up to 25 million ounces in storage. As of the end of this week, gold prices dropping a bit and coming down to $1,730 per ounce. Silver inventories, as the supply deficit continue dropping, now down to 310 million ounces in storage, as global silver production from silver mines peaked back in 2015, and since then, over the past 5 years, has fallen a bit under 10%, about 8 or 9% from its peak levels in 2015. Silver prices remaining in the mid-17s, about $17.60 per ounce. The platinum group metals, much rarer than gold and silver, their yearly production and thus their inventories as well, only being measured in thousands of ounces as opposed to millions. Platinum inventories still just under 153,000 ounces in storage, and palladium inventories taking a drop, now dropping from 30,000 ounces in storage down to 27,500 ounces in storage. And that's down from still having about 54,000 ounces in storage only a few months ago. So that line continues growing thin for palladium, and palladium prices collapsed when the rest of the market collapsed because of all this stuff. However, they're going to have to start getting back up there pretty soon, because this line is getting thinner and thinner. Platinum prices being at about $885 per ounce, and palladium prices dropping back under $2,000 per ounce down to $1,980. Whereas before all this stuff started, they had gotten up to new highs, up over $2,700 per ounce. And rhodium also had hit new record highs. It had gotten up to over $13,000 per ounce. And its price collapsed along with everything else when the market collapsed. However, rhodium has been quickly recovering and is now back up to $8,700 per ounce. In the base metals, aluminum inventories continue jumping up as they're getting large bulk shipments from the large aluminum mining nations. Global aluminum inventory is now up to 1.47 million tons in storage. And aluminum prices still hovering right in the same range at about $1,500 per ton. Nickel inventories still at about 234,000 tons in storage, and nickel prices still hovering around $12,200 per ton. Lead inventories jumping up a tiny bit, from 74 up to 75,000 tons in storage, and lead prices dropping a bit further down to $1,650 per ton. And zinc inventories jumping up from 99,000 up to 107,000 tons in storage, and zinc prices remaining in the same range though, about $1,980 per ton. And the International Lead and Zinc Group released their monthly lead and zinc global mining update. Global lead production from lead mines peaked back in, I believe it was 2013, and has been on the decline ever since then. Global zinc production has been not peaking, but it's kind of been a bit wobbly. So we now have the March data for this year. So the total mined numbers for January through March for each year, for this year and last year, to compare the two. In the first 3 months of last year, about 1.14 million tons of lead were mined. In the first 3 months of this year, only 1.1 million tons of lead were mined. In the first 3 months of last year, 2.98 million tons of zinc were mined. And in the first 3 months of this year, about the same, just under that, 2.97 million tons of zinc were mined. So global lead production continuing to decline. So we'll inevitably be seeing inventory reductions and supply issues with that. And tin actually finally started getting tin inventory data again. Tin inventories are currently at 6,820 tons in storage, which sounds really low, but that's actually within tin's normal range of between 5 and 15,000 tons in storage. It's on the lower end of normal, but it's still within normal. So below 5 is really low for tin, above 15 is pretty excess, and tin prices are currently around a normal price for them, at least in present day, which is about $15,400 per ton. And looking at a few other randomly selected metals, or semi-randomly, molybdenum, one of the numerous alloying components of various types of steel. Molybdenum in particular gives a lot of structural strength, so it's alloyed in steel to make lots of structural steel, so the types of steel used in, the beams to construct buildings and bridges and the like. Molybdenum has sunk over the past several months down to $21 per kilogram. Iron, plain old iron, the foundational ingredient of steel, along with carbon and manganese. As all steel, no matter what your end game alloy is, all steel at its foundation is always made of iron mixed with a little bit of carbon and manganese. Iron actually recovered a bit. It had been down in the 80s. It's been climbing back up now, up to $97.50 per ton. And global iron production from iron mines is recovering after a fall. It had peaked in 2014 at 3.42 billion tons mined over the course of the year. However, in the immediate years after that, it plunged down towards 2, and over the past several years, it has been recovering, and in 2019, last year, it was back up to 2.5 billion tons mined. And that's about it for this mishmashed one. So thank you everybody for listening. Like the video if you enjoyed, subscribe if you haven't already. Again, if you want to support stuff, if you want to help me, PayPal, Patreon, both are in the description and are in the pinned comment. But thank you everybody for just being around in the first place. May God bless you all, and I will see you all around next time.